believe it or not, February 1st. Tomorrow, the groundhog may or may not see his shadow. It's Groundhog Day. And I'm Tim Quast. Thank you for joining. Brian Wilson is joining as well. We like to tag team these things if at all possible. And so we're going to do that again today. And the whole purpose is to do whatever we can to help you use the platform to its best effect. I have a number of points to cover. I'm going to talk about using the math for low risk, reliable returns. And it's not perfect, but it does work. Developing a routine, a couple of things about what the data told us, and a look ahead. And Brian's got several points he's going to cover as well. And because I went first last time, Brian's going to go first this time. So Brian, I will turn this meeting over to you.
Sounds good. Thank you. Thank you. Good to see everyone again. Hope you are everyone's doing well today. I thought I would start off today's discussion by bringing up a topic that I had mentioned a couple of weeks ago. I won't spend a lot of time on it. I'll take it offline if anyone's interested in exploring it a little bit more. But it's just one options-related trade that I've been making recently, maybe 1 to 2 times a week. I've been having fairly good success, so I just wanted to share with you what I've been doing. And like I said, I won't get into real specifics, but I'll go ahead and share my screen and show you what's happening here. So I'll give you an example of a trade I made last night coming into today, ALGM. And what I'm doing is I'm just buying at the money puts and calls towards the close of the trading day. And what I'm looking for specifically is volatility in the shares the next day. I don't care which direction the volatility goes. I'm just hoping for 5, 6, 7% volatility, and then I can make money on the option side of the trade. So I bought this yesterday. The reason that I did, price had been declining coming into earnings. You can see that short volumes had risen substantially. And this was being led going into earnings by risk management, which told me there were probably some bets going into the release itself. Shortly after the open today, the stock was up 6 or 7%, and I was able to make 21% on the trade. I've had some losers, just like anything else. I lost 33% on one trade, but I've had others where I made 67% on one, 80% on another trade. And what I do is I quite simply just go to the NASDAQ site, which will give you the calendar, the upcoming calendar. So for instance, Apple, Amazon, Meta reporting after the close tonight. And I just drop them into a portfolio that I just make every day. It doesn't take too long to do it. Show you what this looks like once it catches up. So here's today's earnings portfolio. And then what I'll do, so Apple, Amazon, Meta, all the rest of them are in here today. And I'll just sort that by supply, because that's the principal area that I'm looking at. And I'll just give you 2 examples of ones that I'll look at here towards the close as possible trades. I don't know if I will or not. Part of it's going to depend on how much they cost and what have you. But if I look at ENSG, short volumes right now, 78%. Risk management going into the earnings print. If you look at the setup here, well, price is just coming under a little bit of pressure. Short volumes are starting to rise. So that's definitely one that I'll take a look at towards the close. And it doesn't have to be just on the high short volume side. It can be the other way as well. Let me show you what this looks like. So if we go down to the bottom, you see short volumes that are 25%, 31%. And I looked at one earlier, RGA, just as an example. The principle is you're looking for market participants that are getting out in front of their skis one way or the other. In other words, perhaps being too pessimistic or maybe being too aggressive. In this case with RGA, you can see that share price has been rallying, really good short covering So maybe market participants might be getting a little bit too aggressive ahead of earnings. I'm not sure, but that's an example on the low short volume side. And I'll kind of play, both sides of that trade, both with higher short volumes and with lower short volumes. So as I mentioned, if you have more interest in that, just give me a holler. Happy to, walk through that via email, or happy to get together, one-on-one with you guys as well. Did have a couple of other topics I wanted to talk about today. I mentioned in the morning notes, the discussion about outliers. And when you see outliers in the data, it always gives you a little bit of pause. Well, we've had some outliers here, recently. If you look at late December into early January, it was a pretty good example of an outlier. You look at sentiment, and what we're looking at here, for those who are new, this is the S&P 500. The green is broad market sentiment. Think of it as demand, and down below, short volume or supply. What was happening in the latter part of December into early January, we were tracking demand that was falling pretty rapidly, and short volumes were climbing rather rapidly. That's normally an environment where you would have, at the very least, some losses in the broad market. And essentially what ended up happening is we were trading sideways. So right away, that gives you pause. They're like, okay, the data is not doing what we think it should be doing. There's an outlier here. And I mentioned in the note this morning, a lot of times when you have those outliers, it points to something kind of happening behind the scenes that will manifest sooner or later. We think what was happening through here manifested in two ways. One, with options expirations right through here in January. And then secondly, once again, yesterday, obviously FOMC decision played into this, but also we had end of month CBOE options that were expiring. That was part of the declines yesterday as well.
Hey, Brian, quick interruption, if I may.
Absolutely, Tim.
Pam's asking a couple of good questions here. She asked, so I think one has been answered. Back to ALGM and similar situations, you're doing straddles. Does the duration of the option matter, the put or the call, in your strategy?
Yeah, I've been generally picking them up maybe 1 week out, sometimes 4 or 5 days. But the ones that I've picked up where there may be 1 month out, I've had not as much success with those. And I tend to have better success with market caps that are, let's say, 5 billion or greater. If you get too much below that demarcation line, it gets a little bit too illiquid, makes it a little bit too difficult.
Yep. Okay.
That's great question. And we were talking about when you have the outliers, and let me go back to my screen here. And part of the reason that we think there was outliers there at the beginning of January is what was happening on the ETF side. And we've had a little bit of discussion around this topic. And not only has the SPY been an outlier when you look at it over the last year, but it's also an outlier when you stretch it back even a little bit further. So here's the ETF. Look at this outlier in terms of short volumes. What we think was happening at the end of the year is that, think of it as the end of December, where market participants still wanted to have exposure to the market. We're coming into Christmas, coming into the holiday season. There just wasn't much trading available in the market. We think everyone really started to move into the SPY, move into the ETF side. This is on a 1-year basis. If we stretch this back on a 3-year basis, you still see the same type of outlier. The point here is that we've had an outlier in the data over the last 3 or 4 weeks. I think we're still in that area right now. So just be aware that we're still in the middle of an outlier situation right now. Did want to mention one area. I know a lot of you will trade intraday volatility. And the topic here is just to be careful around news. And let's go to big tech for an example. So we've had some recent earnings. We had some yesterday. We'll have some after the bell today. And let's just pretend that you were trading Google or Alphabet yesterday. Normally 1.9% volatility. When you get news in names, whether it be downgrades, whether it be earnings, and some of you have probably seen this already, just be aware that when there's news flow, it can impact things where the intraday volatility, this is the norms, but you can move obviously outside of the norms on a given trading day. So just be careful when there's news related items. This will normally work very, very well when there's no news in the name or no news in the space. But if there is news, just tread a little bit more carefully because this is for normal no news days, if that makes sense. And then the last area I wanted to cover just has to do with market behaviors. And the question I had was, can market participants, be wrong? Are they ever incorrect in the way that, they're setting up their positions? And I think inherently, let me do this for 6 months. I think inherently we know the answer to that question. There are various times where market participants will get too aggressive either one way or the other. Here's a great example going back to late October. Market had come under very heavy pressure. You can see that broad market sentiment was declining at the time, and the market quite simply became oversold. Market participants had become too aggressive on the downside. They were positioned wrong going into late October. The whole market was underweight at that time frame. And of course, we saw, just a tremendous rally coming out of there. Now, at the same token, look at yesterday as an example. We're flying high, right? Demand is starting to increase across the market. Short volumes are starting to move lower. In fact, big tech going into yesterday, demand was increasing, short volumes were falling. Everyone was prepared basically for additional upside, whether it was with tech earnings, we'll just enlarge this, whether it was with tech earnings or whether it was ahead of the Fed. But the thing is, this is what market participants are doing. They may or may not be right. And sometimes they can get too aggressive as buyers, and sometimes they can get too pessimistic as sellers, and they can swing both directions, really go in the ditch either way. So I think that was the here one other example. If we look at Alphabet going into earnings yesterday, they came under a lot of pressure, and we would quite simply say that market participants were not prepared for it. Look at the setup going into earnings. Demand had been rising. They were at a 10. Short volumes were low. You would say that's a pretty positive setup going into their earnings print, and it certainly was. And market participants, quite simply, were just prepared in a wrong manner. And it does happen sometimes, but the takeaway here is that the edge data will tell us how everyone is positioned right now, but it doesn't, it's not going to tell us whether they're positioned correctly, because sometimes everyone can be doing the same thing and they can be doing the wrong thing. So I think that was it, Tim, for me.
Okay, thank you very much, Brian. Now the B team. Hey, so I've got a number of things to discuss too, and once again, thank you for doing this so consistently, week in and week out, and we appreciate that. As I said, I said I would do this in the market desk note. I said, let me talk a little bit about the math. That the use the term the math all the time, and you might say, well, what math is that? what exact math are you referring to? And I'll show you. Yeah, I mean, this is the raw data behind the scenes that goes into this stuff. What we do is, I say we look at period and pattern data. And once again, and this will be, you veterans, you know these things. If you're new, I'll explain this for your benefit, and we have a smaller group today, so maybe there are just a couple who don't know these things. But we look at trade execution data. So what we're concerned about isn't technical signals or fundamentals. It is quantitative data, and it's about how trades get handled. And if you're trading all the time, you see this. You see that prices change constantly. The supply of shares at the bid and the offer is constantly changing. Well, how can that be? Well, because the market is driven by math. Machines set almost all of the prices. I mean, all the quotes you see, virtually all of those quotes are going to come from the fastest machines in the market. So you can suppose that most of the time, call it 98% of the time, the price you see at the bid and the offer is coming from some unthinking, very fast machine. And that machine has a routine and an objective, just like we should. This is why I say, which will differ a little bit from Brian's talking about a different application of the data than what I will talk about. So you get two sides of the coin. There are different things you can do with edge data. You could do long-term portfolios. You could do straddles like Brian is doing, where he looks at the supply-demand balance and figures out what to straddle and how much it's likely to move. If you were managing a long-term portfolio, you would want to fluctuate your exposure to equities based on how the market moves relative to the red line. So even here, if you looked at the data, you would say, well, I don't want to keep putting more money into the equity market here, even though you will get the occasional outlier. And I'm going to talk about that. And when we're below the green line, when this green part of the graph is below the green line and supply is falling, well, you can increase your exposure to equities. I actually do it with the folks who run managed accounts for me. I will send them a note and say, well, here's what I want to do. So I can have some input on those things. Then if it's short term, and when I say short term, I mean 1 to 5 days. That, it's the part of the market that isn't heavily occupied. High frequency traders have a horizon of, let's call it, a day or less, and particularly milliseconds, and they're very good at that. Citadel is very comfortable taking a tenth of a penny from you over and over, and they don't go, oh, I wish I could have gotten another 2%. It's going to take their little piece, right? That's all they're after. And so when I'm after 1 or 2%, I don't look backward. I just take that, and if I get it, I'm happy and I move on. Don't go back and go, man, I should have stayed in another 5 minutes. No, don't worry about that. If you're following your plan, and you have a sound mechanical basis for it, it will produce returns for you. Look, it doesn't work every time. There are times when I've been testing long-short strategies based on supply-demand balances, and I'll tell you what I did today. And I don't get that right all the time because it's new for me. If I'm doing something like trading low volatility, something like you could pick your stock out of here. But like State Street. So, if State Street is in a part of the market that's doing well, if financials look good and you look at State Street and it has very solid demand and generally falling supply, and it has volatility of 1.7%, I could take the closing price, 73.87, and I could put it in a model, and let's see, here it is. There we are. Put it in a model, 7387. And I might do this. By the way, we're thinking about, can we improve this usefulness for you? We're working on these interactive brokers data visualizations for integration, and Steve Hicks, by the way, we're probably 4 or 5 days behind schedule. I would say we have a meeting tomorrow morning We've got some work to do over the weekend. We're getting very close on it, though. I feel good. I always know programming takes longer than you anticipate. So that we're this close to my target, I'm pretty happy with. So I have put in, this is half that volatility. If volatility is 1.7%, 0.17, and I want half of that, let's say, it doesn't have to be perfect. I just want to have a general idea where I might want to buy this. So if I bought it at somewhere around 73.30, then what am I after? Well, maybe 1%, maybe 0.5%, right? Maybe about the same. You don't have to get a lot. If you're trading $50,000, let's say, you can produce 1% almost every day doing this. Not every day. There are times when you just shouldn't do things, but it's that simple. I could give you several examples today. I did something differently, but I want to show you this because it's just additional proof that this works very well, and there's a reason for it. The reason is machines are generally responsible for prices. I just want to get to a browser here. Hang on one second. So if machines are generally responsible for prices, and we know several things to be true about the market, such as generally the volatility of derivatives, let's call them, all the ETF market, part of the market, SPY, is about 1%. It's a little less right now, 70 basis points to 90 basis points, but call it 1%. And then the underlying assets are moving 2%. What will that tell you? Well, it's probable that if machines want to capture what lies between those things, that if the market or anything moves half of it, that's a pretty good signal. And it's very true with the broad market. You can look at the S&P 500 moves 50, might bounce a little bit beyond that, 60 basis points. It's probable that there will be a reassessment. It's not anybody thinking about it. It's machines calibrating which side to be on. So you could do that, look at SoFi today. I looked at it, it was down 3%. And I thought, well, that's really pretty good. Right? If you bought it here, 3% down, you could have made all of that back, basically. Well, that's a really nice trade. How would you know that that would happen? Well, you can look at the supply-demand balance in SoFi and say there's a high probability, if there is excess demand, that at some point today, all other things being equal, it will retrace that. And I want to talk about those all other things being equal. You could look at this. These were all choices I looked at. And I went, well, there it is. That's down half its volatility. Probably could buy that. And it might not hold up in the last hour. There are reasons for that too. You could look at, it's my least favorite of the lot purely on price. But if you looked at United Rentals, same thing. I'll admit, I don't love high price stocks because I can't buy as much of it. And it takes, if I'm trading $50,000, I can't even buy 100 shares of that. So I rank it lower, but did it work? Well, yeah, it did. It was down its volatility. And now how do I know it's just going to keep right on going? How do we know that it's likely to rise? I'll show you, right? It's not absolute, but we can have a very high confidence in what things are going to do. So that's the math I'm talking about, but it depends on understanding how the market works. Machines are setting price. Yes, Steve.
So did you run back test? How did you come up with your 0.5%? I mean, that's what I started with, but I'm wanting to find out, have you done back testing to see if overall it's better to wait for 0.75%?
We did do back testing, and really, truth be known, this is why in the IBKR model, it'll be half to a third up even, because the truth is, you don't have to wait for it to be halfway down. You could be right in here, somewhere in here, and mathematically it's the same. We ran a lot of data on down half the volatility. Then we ran just midpoint. And actually midpoint is slightly more likely to produce 2% in 5 days than is buying half the volatility down. So they're about the same. That's why, you feel better about it, right? There's a psychology involved too, because here's the beautiful thing. If you buy something that's wrong spot. Okay, so if you buy this at 73.87 and it goes down to 73.30, you only need it to go back to 74, which is 13 cents off of where it closed yesterday, to make your money. So it feels better to you. Statistically, is there any real difference? I could just buy it at the midpoint, truth be told.
What about the number of stocks that go down a half versus 2/3 or a third? How many are you losing by going to a half instead of a third, or versus also going on down to 2/3, let's say?
Yeah.
That equation of where you want to select and is a tough one.
Well, and you raise that's where the rest of it, that's where the ceteris paribus, all other things being equal, comes into play, right? You can't. Why wouldn't I just trade volatility then? I could just trade any stock. I could go find all the stocks volatility, and when we measure volatility, we're talking about the average change between intraday high and low. There are other terms for it, Pam. I forget. You told me one term for that. It's what is it? The term just flitted out of my head. That's what we're measuring. So you could say, well, why don't I just go screen for volatility and then find any stock that's halfway down it? Because that by itself does not work. It's so it tells us that the machine setting prices are very aware of the supply and demand in the market. Now, how are they doing that? Well, because they buy all the data. You may do this too. I pay $5 a month to get real-time data from the NYSE, the NASDAQ, and the SIBO, right? So and it's incredible how those prices are changing. So I'm sure that the machine like Citadel is going, well, I know if there's a bid-ask imbalance and for how long that's going to last. So that's why it doesn't absolutely work. Yes.
What about the relationship of whether SPY is up or down?
That is crucial. So there are three things that are crucial in this equation. And they are, number one, you're absolutely right. You got to know what the supply demand balance is in the broad market. You have to know if options are expiring or some other tradable event. Jay Powell speaking, earnings affect outcomes. One of the risks with SoFi and Paramount is Paramount's a deal stock. SoFi is in the financial sector, and we had a blow up yesterday. I don't know if you saw it, and New York Community Bank. Is that another canary in the coal mine? Well, it could be. And if that would affect SoFi because passive money is so large, the reason stocks move in tandem is because passive money buys massive basket, buys the herd, not the outlier. So those things really matter. So if you put all three things together, maybe four, let's call it four. So you have supply demand imbalances, you have volatility, you have what the broad market is doing, and you have the tradable events, particularly options expirations. And look at this. Options expired here. What did the price do? Right into them. Month-end expirations bump up and down. Options expirations split into two across a week, and look what prices did. Up, down, up, down. And month-end options expirations, that was the decline for the market. Options expirations, market jumped. Options expirations, market fell. It doesn't happen every time, but it happens a lot. So you have to know those things. So you want them all. If you want the ideal outcome, you go over here and you say, okay, broad sentiment is rising. There are no options expiring. We're not in an earnings period, and there are 20 stocks in momentum. I'm buying momentum all day long, right? That's what I'm going to trade. Even now, I was happy with momentum because now it's a coin flip between low volatility and momentum. By the way, it's not that they're highly correlated to the market. That momentum correlation has improved. In fact, if you look back over the last 3 quarters, momentum is more highly correlated now than low volatility. It was not true a year ago, but still, they're not highly correlated. But that's the key. And you say, those are too many things to think about. No, they're really not. I'm a simple guy. You just have a routine. You want to know, what do you do every day? Well, I say you look at broad market sentiment. I like to look at where these things are. Momentum, are there good opportunities? And does it jive with the market? And it did. So this is the rest of the answer to me, Steve, is so today, well, yesterday, actually, right in the last 4 minutes of the market, I bought SQQ short the NASDAQ 100 and long the NASDAQ 100. But I doubled the exposure to long. Now, why would I do that? Well, because look at the data, right? If I look at mega caps, it's changing, but I'm comfortable with that. Broad sentiment's at 5. It's rising. The supply side is falling. Okay, that gives me comfort. I go look at big tech. It's going to break down. It's starting to break down. But I know that there's a delayed effect. There are 12 instead of 7 in momentum. Low volatilities come down. That means that gives momentum a little more probability. So, and I look across my dashboard and I go, well, it's not falling apart. All the supply demand balances are breaking down. They are, but they're not done yet. So then I did 2-to-1 leveraged long. Now, unfortunately, I went to walk the dog and I put a stop and limit around it, and it ran the market. And in fact, I complained to IBKR about it because it moved 50 basis points through my order and then back up. Didn't stop me. I waited for the market. The market went up, came back down. I bought it again. I made that money back. So it's not that I lost money. I didn't make my return until the second time. But was the math right? Absolutely. And I'm not gambling. I'm banking on all of these things giving me an 8 or 9 out of 10 shot at producing a return. Because otherwise, how would you know? How would you know that if SoFi is down 3%, it doesn't go down 7%? It's got volatility of 6.9% because machines set the price. The supply-demand balance is clearly long, and machines are going to be tempted to move the price up. And son of a gun, they do it almost all the time because I know what they're trying to do. They're crossing the spread. That's what they always do. They're going to take half to a tenth of it. That's the reason there's variance in it. Those are the rules. So I'm just applying all of that thinking in a very simple format so that I can have a confidence, a level of confidence that I'm going to make the right decision. And I get notes from people like, oh man, I didn't get a return on this. And I look at the stock and I say, well, but you bought falling demand and rising supply. I can't do that. I had a perfect supply demand spread and I lost money. I said, did you look at the broad market sentiment? It's not pulling in your favor. What just happened? Options expired. Look, you could look at this and say, I should short the market here, right? If you have falling supply, rising demand, why wouldn't I short that? And I agree. It's why I had flat trades all through there because I did too. Don't take any chances. I had a difficult time producing a return. I didn't lose money. I just stayed the same for across here because the market didn't move as the math indicated. Now, why was that? Well, as Brian said, what this data tells us, I'll show you. What this data tells us is people are borrowing heavily. There will be a consequence. When is it likely to show up? Well, it could show up when month-end options expire and Jay Powell speaks. Sure enough, it can be delayed. But it will always come around. And I'm not saying that we're going to get out of this, even with the rising demand and supply. This could still be a consequence. And I also like to look at SPY because SPY, people are so dependent on this. We were talking about this internally. There is now, to me, as high a level of passive investment in SPY as I've ever seen, meaning all those people who are supposed to buy the basket of underlying stocks, they're doing that too. Their levels are very high in that, are buying SPY because they can't get stock. When levels of borrowing go up, when the use of derivatives go up, it's because there isn't enough of the actual product. And so I look at this and say, actually demand and supply are now converging in SPY. It's not bad, but we've gone from this long run where supply has fallen to where supply is flattened out now for better than 5 days above trend, and it's running. If you ran a correlation now, the standard deviation is narrowing, right? So you look at that and say, well, unless that could mean another shoe could come out of this. Again, I'm not saying it's gonna. There's another thing I would note about this data and how accurate it was, telling us to be very careful about momentum. Remember, there were 20 last Friday in low volatility and only 6 or 7 in momentum. We're going to put that number on there too. So what would that tell you? Be very careful about momentum. Think about low volatility. And sure enough, that was good protection for what happened here. But that to me is the math. That is the math that is constantly informing me about what to do with Edge. Okay, that I kind of blended my points together there, and I'll stop sharing so we can talk about. I think, is there a question? Did I answer questions? We'll talk briefly about what's coming. But hey, Barry Bailey, I followed your example. And I mean, I've
Oh
got a
my
little
God.
stubble today, but I got rid of the mountain mellow. I figured it's time for me to clean my act up, you know.
Karen got a hold of you too, it looks like.
Exactly. so so did that. That's what I mean by the math. And I look at those things. I develop a routine. I look at the same stuff every day. It works. Doesn't work perfectly, but it works so well that I massively outperform my managed accounts. So that's, it works. What's ahead? And Brian Wilson, you can weigh in. I've sort of touched on that. If I look at the whole thing, well, I'll go back. I guess I have to share this again. I'll leave you with this last thought. We can let's go right down the list. SPY, let's pull that up. Not that it's number one. To me, broad sentiment is number one because it's the underlying asset. But, it's at 5. There's nothing causing me to think that this is going to fall apart. But I'm going to watch this. Clearly, the supply-demand equation that gave us this great run, that was insufficient supply, very strong demand. This was wildly low. I mean, we rarely in the entire data set see something like that. So let's call it kind of like Goldman Sachs did. They said, the last quarter in the stock market was in the 99th percentile of all market data for performance. What's the probability then of duplicating that? 1%. That's my addition to it. It's not theirs. So that's changing. Now it's not giving me any indication that there's particular trouble, but it's certainly telling me that we're not likely to duplicate what just happened. So then we go to broad sentiment. This is, again, balance of supply and demand. It looks pretty good. I mean, this is coming down. Demand is rising, but this never produced the consequence that it should and almost always does statistically. And here's the trouble. If there's volatility in the market, and you have, as a large institutional investor, substituted options and futures to true up your tracking, and you have a lot of them, and the market moves more than 2%, it could be that you now have very large tracking errors because you will have to mark those derivatives to market, and it could be 0. I'm not saying that's going to happen or that has happened or that they don't have some time to remedy it, but I'm saying if the market's had half of that volatility, that's the thing. This is the biggest move since September. And so that is going to have some effect on tracking. And if it's bad, somebody who's responsible for that will have to sell some assets. Okay, so you just have to think about that. That's all. I look at it and say it's fine. I look at the dashboard, momentum, fine. Low volatility, fine. Still 108 people, if this deteriorates to below 100, there are 100 stocks with over 100 billion of market cap, believe it or not. So it's crazy, right? But they could be right at 101 billion. And if the market deteriorates, then suddenly you drop out of that. At big tech's the linchpin. You notice now that Tesla for 1 month hasn't performed well, and now we've switched from saying the Magnificent Seven to the Super Six. Only takes a month and you're out, right? It's just so I watch that. All of these things look fine, but to me they look like all these supply demand curves. See them? They're aged, and they could be fine, but this is to me very late in this cycle. And does this have anything to do with what the Fed said? That to me goes all the way back. The recalibration of hedges and global macro asset balances, that goes back here. Where this happened, here, and here, all tied to these 3 derivatives resets periods, because there are massively more interest rate and currency derivatives and forwards and swaps than there are equity instruments. So the equity instruments get rocked by those. And so those have all been reset. But I don't know. I just get, I think that we want to be, when we're not sure what the consequences are, you just keep your time frame short. I'm going to look at the market, see if there's anything I want to buy before the close that I feel how do I feel about Friday? Feel fine. New month, new money. I don't think it's going to fall apart tomorrow, but I don't know. I'm just going to make sure that the odds are stacked in my favor, whatever I pick, whether it's a leveraged ETF instrument or an individual stock. Okay, thoughts, comments, concluding words of wisdom?
Tim, can you show the filter on your mega cap?
Oh, sure. Yeah, it's very simple. I just I think I just take large caps. I'll have to look
Just
at
the one, just the one large mega cap, and that's it.
Oops, I clicked on the wrong thing. I think that is right, Barry. Let me just check. It's got one criteria. Yeah, it's all mega cap.
Yeah,
I
got it, 108. Perfect.
Yep. Okay, good.
That's a nice metric. Thank you.
It is, because that is a major part of all market cap right there. Believe it or not, there are only 296 large caps in the Wilshire large cap index of the entire market. So, I've got at least half of it, and I know you can dump that export that to Excel, and you can tabulate the market cap. Just go here, dump this. I realize I need to stop. We're over time here. And you can tabulate how much market cap it is. I'll do this really, really fast. Able, running slow here. Okay, which is L. So if I just ran this calculation here for what's the total, it's 35 trillion, right? So that is more than, let's call it 60+% of all market cap is right there in those 100 stocks, right? It's crazy. Yeah. All right, so that's plenty for today. We could do it again next week. Thanks for sitting in, everybody. Good to see you all.